it has failed to follow through. And then the entry tactic could be a 3-bar reversal. You count back, starting on the close of that bar, count back 1, 2, 3. We've got as soon as the market breaks above that high, we have a potential entry. And you could enter right there. This is one of those times where the market happened to whipsaw back. This is the Little Dipper again. The market pushes down into the prior area of support and then pushes itself back up. Okay, I don't want to get too sidetracked there. But so it's a progression. It's a progression of concepts. It's a progression of trading setups. Okay, I may have missed this, but if you trade in units of 8 and 2, you mentioned that you often sell the 8 and retain the 2 for later sale. It appears that you are not applying the same rules to the remaining 2, such as always seeing that you expect a 2-to-1 ratio of returns to losses. If this is true, why don't you consider this remaining 2 on the same basis as if you were just making a new investment for 2 at the same time you sold at your original 8? Aren't you taking a higher risk? It's not as simple as that. And you've got to avoid oversimplification. If I were, for example, buying, let's say I bought as the market breaks above this high, and then I exit after the market has moved up 23 pips. I exit my first, I bring my stop up to break even, and then I let the other 2 ride. It is true to say that in the 2 that I have on in the marketplace, my initial risk is what? 23 pips, because I'm willing to get out at break even. So I'm risking 23 pips of profit, but am I losing equity? Okay, no, I'm not, and I'm looking at risk at this point in terms of equity, not open profit. Okay, now could you manage the position as if you had a new position on? In other words, you get in long as the market breaks above here with 10. You exit 8 here. Could you then assume that the next 2 and act as if you had just gotten in right there? Yeah, you could. I don't trade that way, so I wouldn't be able to comment on the system at that point. I'm just not familiar with it. I don't trade that way. So again, are you taking a higher risk? No, in terms of equity. You're not taking a higher risk in terms of open profit because the position is smaller, even if you do have the 23 pips worth of risk. Okay, so because you've locked in the profit, again, if you're going long above here, you get out 8 at 20. 8 times 20 equals 160. So even if the other 2 went down all the way to break even and got you out, and for the sake of argument, you subtracted that from this, which isn't logically or mathematically correct. But even if you did, for the sake of argument, subtract the loss here from 160. Don't do math while I'm recording. Minus 23 or 20. I'll use 23 since I plugged that in already. 137 would be your net profit. So you're still profitable. I look at risk in terms of, is it going to draw down my equity? So if I start off the day and I've got $15,623, if I end the day with $15,412, then I took some risk that day, meaning I lost money. Okay, so that's the risk. And the next day I'm starting off with this balance. So if the next day I wind up with $15,874,